Welcome back to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan, and we're here to keep you updated on the latest trends, developments, and regulatory changes affecting the real estate and mortgage industry in Ontario and beyond. Whether you're a homeowner, prospective buyer, or industry professional, we've got the insights you need to make well-informed decisions. In today's episode, we're diving into the economic challenges that Canadians are facing despite 3 early rate cuts. This topic is particularly important as it impacts everyone from homeowners to renters, and even those considering entering the market. So let's get into it. Despite 3 interest rate cuts since June, Canadian consumers still appear to be feeling more stressed than their neighbors in the United States, where the Federal Reserve has yet to start any reductions in borrowing costs. The persistent financial pressure reflects the vagaries of the Canadian mortgage structure, a surge in rents, and a heavy debt load carried by many households. All 3 have crimped disposable incomes. With more mortgage renewals coming up and high population growth putting more upward pressure on rents, analysts and economists say Canadians will feel stressed well into next year and beyond, keeping economic growth muted. The outlook remains muted even though Canada got a head start in lowering borrowing costs, becoming the first economic power in June to cut rates in the current cycle. It has followed up with 2 more cuts, bringing the key policy rate to 4.25%. The Federal Reserve is likely to cut its benchmark rate for the first time next week, with markets now debating whether it will start with a 25 or 50 basis point reduction. Canada's inflation-adjusted per-person expenditure has fallen by 2% since the peak of 2022, and 1.1% annually in the second quarter, showing that consumers are reeling under the burden. By comparison, inflation-adjusted spending in the United States grew 2.7% annually in July and is generally considered to be in line with the pre-pandemic trend. This divergence mainly reflects the differing structure of Canadian and United States mortgages. What you're seeing in the United States is a preponderance of 30-year fixed-rate mortgages, said Randall Bartlett, Senior Director of Canadian Economics at Desjardins. It's very predictable for households, he said. By contrast, most Canadian mortgages are either variable rate or adjustable after 4 or 5 years. For homeowners with low-interest loans now coming up for renewal, they can expect their payments to jump even with the Bank of Canada's current series of cuts. Bank of Canada. Governor Tiff Macklem said during a press conference in London last week that consumers had less extra money to spend compared with their American counterparts because Canadians were spending more to service their mortgage. About 400 billion Canadian dollars, or 294.55 billion United States dollars, worth of mortgages are set to renew in 2025, out of which more than 2/3 are 4 or 5-year contracts. The 2025 figure is more than 30% of the value of mortgages being renewed this year. It's a wall of mortgage renewals coming up, Bartlett said, and added that this would keep many Canadians under stress way into 2025 and 2026. Elevated debt levels are also a significant concern. Vivek Dehejia, an associate professor of economics at Carleton University, said renters, a category that comprises 2 out of every 5 Canadians, were also feeling the strain. Landlords, themselves burdened with high mortgage payments, are raising rents for their tenants, who in turn are taking on more debt to meet other obligations, he said. That cycle is not likely to ease anytime soon, he said. On the demand side, an immigrant-led rise in population has put upward pressure on Canadian rents, which rose 8.5% year-on-year in July. Canada's household debt levels were already high when interest rates started rising after the pandemic, and that has made conditions worse, analysts said. Canada entered the pandemic with a very elevated level of vulnerability to interest rates, said Carl Shimada, chief market strategist at Corpay, a global payments firm. He said the big interest rate tightening cycle, which began in early 2022, had a disproportionate impact on Canadians. The total household debt exceeds the size of Canada's gross domestic product, while in the United States that figure was less than 3/4 of the size of the economy as of March 31st. In the first quarter, Canadian households spent around 15% of their disposable income to meet debt servicing costs, while Americans paid about 10% of their income, according to official data. Now they are forced to save more to meet debt obligations. Canada's household savings rate touched 7.2% in the last quarter, its highest in 9 quarters, while in the United States it was at 2.9% as of July, the lowest since June 2022. That number indicates United States consumers were still spending much more despite high rates. Economists anticipate that Canada's annual inflation rate in August fell to its lowest level since March 2021, by Sammy Hughes. Ahead of Statistics Canada's Consumer Price Index set to be released on Tuesday, economists polled by Reuters are expecting the report to show prices rose 2.1% from a year ago, down from a 2.5% annual gain in July. The forecasters also anticipate inflation remained flat on a month-over-month basis. Unless there's something lurking out there that we're not aware of, it looks like we're headed for a pretty favorable reading, said Bank of Montreal chief economist Douglas Porter. Royal Bank of Canada economists Nathan Jansen and Claire Fan said in a report last week that those expectations would put the headline inflation rate just a hair over the Bank of Canada's 2% inflation target. Most of that August slowing is expected from a pullback in gasoline prices. But the Bank of Canada's preferred core consumer price index measures are also expected to trend lower, with the closely watched 3-month annualized growth rate easing from an average of 2.6% in July, the Royal Bank of Canada economist said. The continued progress on slowing inflation comes as the central bank has signaled a willingness to speed up cuts to its key lending rate if circumstances warrant. The Bank of Canada reduced its key lending rate by a quarter percentage point earlier this month, the third consecutive cut, to 4.25%. Governor Tiff Macklem said the decision was motivated by falling inflation, noting if the consumer price index moving forward was significantly weaker than we expected, it could be appropriate to take a bigger step, something bigger than 25 basis points. On the other hand, Macklem said if inflation is stronger than expected, the bank could slow the pace of rate cuts. Inflation has remained below 3% since January, and fears of price growth reaccelerating have diminished as the economy has weakened. Porter said despite progress on the inflation rate, it's still not in a place where it's a compelling argument that the bank has to go even faster. He forecasts the central bank will cut its key lending rate by a quarter percentage point at every meeting until July 2025, bringing it down to 2.5% by that time. That prediction also comes after data released last week that showed Canada's unemployment rate rose to 6.6% in August from 6.4% in July. However, Porter said it's possible the bank could speed up its rate-cutting cycle if inflation continues easing. If we're going to be wrong, it's that we're going to get to 2.5% even more quickly and possibly lower than that, said Porter. There is a case to be made that if the economy were to weaken further, there's little reason for the bank to keep rates in what they consider to be the neutral zone. They could go below that. Shelter costs have remained the main driver of inflation as Canadians face high rents and mortgage payments. Porter noted that when factoring out housing costs, inflation in both Canada and the United States is hovering slightly above 1%. So, really, the only thing keeping Canadian inflation above 2% is shelter, and it does look like shelter costs are probably going to fade, he said. It looks as if rents are starting to moderate. They're not necessarily falling, but not rising as quickly. And of course, with interest rates coming down, ultimately the big kahuna here, mortgage interest costs, will recede as well. With the United States Federal Reserve set to meet on Wednesday, Jansen and Fan said they expect the American Central Bank to announce its first rate cut in 4 years. Gradual but persistent labor market softening and slowing inflation make it clear that current high interest rates are no longer needed, they wrote. We think Governor Jerome Powell's comments will likely stay on the cautious side, hinting at future rate cuts without committing to a predetermined path to allow for more flexibility in future decisions. Now let's shift gears and dive into our weekly Mortgage Digest, where we'll take a look at recent trends and key headlines in the mortgage and real estate markets. This week, we're focusing on how Canadians are pulling back on borrowing for the second straight quarter. According to recent data from Statistics Canada, household credit market borrowing slowed slightly to $25.1 billion. The slowdown was largely driven by a decline in consumer credit lending, which fell from $7.8 billion in the first quarter to $4 billion in the second quarter. However, mortgage borrowing saw a slight rise in the quarter to $18.3 billion, up from the $17.3 billion recorded in the first quarter. High interest rates are working, as the advance in household consumption is slowing down, which is the intent of restrictive monetary policy, noted Randall Bartlett, Senior Director of Canadian Economics at Desjardins. But he cautioned that the Bank of Canada faces an ambitious task of achieving a soft landing, given present vulnerabilities and future headwinds. One major concern is the additional strain on mortgage holders, with a significant wave of renewals approaching. As of May, the Bank of Canada estimated that around half of mortgage holders had yet to fully experience the effects of higher interest rates. Once these households experience a mortgage renewal, they will face significantly greater financial strain because of higher monthly payments, Bartlett wrote. He also highlighted increased financial stress among non-mortgage holders, who are exhibiting a growing reliance on credit card debt to fuel their purchases. Here are some other highlights from the second quarter national balance sheet and financial flow accounts. Household net worth edged up to $42.4 billion, a 0.2% increase quarter over quarter. The household debt service ratio, which measures the portion of disposable income used for principal and interest payments on credit market debt, rose to 14.97% from 14.89% in the first quarter. The mortgage-only debt service ratio reached a record high of 8.18% in the second quarter, up from 8.07% in the first quarter. The household savings rate rose 7.2% as growth in disposable income outpaced the rise in spending. Real estate activity in the second quarter was the weakest in 4 years, leading to a slight 0.1% drop in the value of household residential real estate since the first quarter and a 0.3% decline year over year. Real estate accounted for nearly 43% of the value of total household assets. In other news, Toronto's new home sales hit an all-time low in July. According to the Building Industry and Land Development Association, only 654 new homes were sold in the Greater Toronto Area, a sharp drop of 48% year over year and 70% below the 10-year average. Single-family home sales plummeted by 84%, while condominium sales dropped by 62%. This slowdown in sales led to a significant rise in inventory, with 15 months' worth of available homes now on the market. This means it would take 15 months to sell all current listings at the current pace of demand. GTA new home sales in July sank to another record monthly low as buyers remained unwilling to leave the sidelines, said Edward Jegg, research manager with Altus Group. Further expected decreases in interest rates in the coming months, along with elevated inventories, means there will be plenty of opportunities once consumer confidence improves, he added. In July, 287 condominium units, including apartments, stacked townhouses, and lofts, were sold, down 67% from July 2023 and 81% below the 10-year average. Single-family home sales totaled 367, a 1% drop from last year and 42% below the 10-year average. Bank of Canada Governor Tiff Macklem recently hinted at the possibility of deeper interest rate cuts if inflation continues to cool and economic vulnerabilities grow. During a question and answer session in the United Kingdom, Macklem emphasized that the central bank's priority remains controlling inflation, but acknowledged that more aggressive rate cuts could be necessary in 2024 to ensure a balanced recovery. We now have some slack in the labor market, he said. With inflation getting closer to target, we actually want to see growth pick up. We want to see consumer spending strengthen. Last week, the Canadian Imperial Bank of Commerce released an updated rate cut forecast in which it predicts supersized rate cuts by the Bank of Canada by year-end. Let's move on to some quick mortgage snippets. Canadian building permits surged 22.1% in July. Building permits rose to $12.4 billion after 2 months of decline, according to Statistics Canada. Residential permits rose 16.7% to $7.6 billion, driven by a 29.3% increase in multi-unit permits, while single-family permits dipped 1.9%. Non-residential permits jumped 31.8% to $4.8 billion, with Ontario and British Columbia leading the gains. Ontario saw a 23.8% rise, and British Columbia experienced a significant 99.2% increase. Nationwide, permits were issued for 20,700 multi-unit and 4,100 single-family dwellings, bringing the 12-month total to 266,200 new units. Some first-time buyers can now extend their amortization to 30 years, but should they? While a longer amortization can help with affordability in the form of lower payments, experts warn that it comes with a catch, paying more in interest over time. It's a trade-off between short-term relief and long-term costs. It's dangerous window dressing because it sets an expectation that your first home should be brand new, and that if you cannot afford a 25-year amortization, affording it on a 30-year amortization makes it okay, noted Colin White, Portfolio Manager and Chief Executive Officer of Verican Capital Management. In a lot of cases, it's nice to be entering retirement or the next phase of your life when your debt servicing years are behind you. Royal Bank of Canada has appointed Catherine Gibson as its new Chief Financial Officer, following the departure of Nadine Ahn, who is currently involved in a legal dispute with the bank. Ahn, who left the role earlier this year, is suing Royal Bank of Canada for wrongful dismissal, while the bank has accused her of misconduct. Gibson, who has been with Royal Bank of Canada for several years, takes over as the bank navigates both the ongoing legal battle and broader economic challenges. That's all for today's episode of Ontario Mortgage and Real Estate Insights. Thank you for tuning in. I'm your host, Steve Hammond, and we'll be back next week with more updates and insights. Until then, stay informed and make smart decisions.